A 65% price cut from a global banking giant sounds scary at first. When most people hear that a major bank has lowered its price prediction for a cryptocurrency, they immediately think the project is dying. But what if the opposite is true? What if that price cut is not a warning sign, but actually a buy signal for smart money? Right now, a massive conversation is happening in the crypto world. One of the world's largest international banks, Standard Chartered, recently shocked many investors by cutting its 2026 price target for XRP to $280. A lot of retail traders looked at that headline and panicked. Social media quickly filled with comments like XRP is finished or the banks don't believe in it anymore. But here's the reality that most people miss. When big financial institutions adjust their price targets, they are not reacting emotionally like retail traders. They are adjusting strategy. And sometimes lowering a target does not mean losing confidence in an asset. Instead, it simply means they want a cheaper entry point before the next major cycle begins. So while many small investors are running away from the market because of fear, institutional players could quietly be placing buy orders at lower prices. This difference between retail emotion and institutional strategy is one of the biggest lessons you can learn in the crypto market. But before we break all of this down step by step, welcome back to the channel. If you're new here, this is We Are Cosmic, the place where we break down crypto markets, digital assets, and the future of global finance in a way that is simple, clear, and easy to understand. On this channel, we don't just follow hype or social media trends. Instead, we analyze real financial data, institutional strategies, and long-term market cycles so you can understand what is actually happening behind the scenes. If you enjoy content about cryptocurrency, blockchain technology, and the future of money, make sure you subscribe to the channel and turn on notifications because the next few years could completely reshape the global financial system. Now let's talk about what this new price target actually means. When Standard Chartered reduced its 2026 projection for XRP to 280, many investors immediately saw it as negative news. But professional analysts look at it differently. They understand that a price target is not just a prediction, it can also act as a reference point for risk management. In simple terms, when a major bank sets a conservative price level, it often signals a zone of stability. Instead of saying the asset will fail, they are essentially saying, this is the level where the market should find balance. Think of it like this. If you know that a large financial institution believes an asset is stable around a certain price, that information becomes extremely valuable. It gives you a clear framework to build a strategy rather than blindly chasing pumps or reacting to market fear. And this is exactly where the opportunity begins. Instead of seeing a downgrade, smart investors see a defined accumulation zone. They start asking questions like, is this price level a long-term support area? Could institutions be preparing to accumulate here? And is the market simply delaying the next major growth phase? Because sometimes the biggest profits in crypto don't come from buying during excitement. They come from buying during uncertainty, when most people are too afraid to enter the market. And according to the data we're about to explore, this new 280 level might actually be one of the most important reference points for XRP investors heading into the next cycle. When a major bank like Standard Chartered lowers a price target, most retail traders immediately assume it means the project has become weaker. But professional analysts know that price revisions often reflect something very different, the reality of the current global economic environment. Right now, the global financial system is dealing with multiple pressures at the same time. Liquidity is tighter than it was during the previous crypto bull market, interest rates remain elevated in many regions, and capital is moving more cautiously across markets. When liquidity tightens, speculative assets such as cryptocurrencies often experience slower growth phases before the next expansion cycle begins. This is exactly the context behind the new 2.80 projection for XRP in 2026. Instead of predicting an immediate explosive rally, the bank is recognizing that the broader financial system may take longer to fully integrate blockchain-based payment solutions. That doesn't mean the technology has failed. It simply means the adoption curve is stretching over a longer timeline. And that difference is extremely important. For retail investors, a delay often feels like disappointment. But for institutions, a delay creates something even more valuable: time to accumulate. Think about it from a strategic perspective. Large financial institutions cannot simply buy billions of dollars worth of an asset overnight without moving the price dramatically. They need extended periods of market stability where they can slowly build positions without attracting too much attention. This is why periods of uncertainty often become accumulation phases for institutional money. When Standard Chartered places a conservative ceiling like $2.80 for the near-term cycle, it may actually be signaling a risk-controlled entry zone. In other words, it's defining a range where downside risk becomes limited compared to potential long-term upside. For investors who understand this concept, the perspective changes completely. Instead of asking, why did the bank lower its target? A smarter question becomes, why would they publish this number now? The answer could lie in how institutions analyze risk versus reward. Banks and hedge funds do not operate based on excitement. They operate based on probability. When they evaluate an asset, they are not only asking how high it could go, they are calculating how much downside risk remains before entering the market. By identifying $2.80 as a stable baseline, the bank is essentially saying that below this level, the asset begins to look mathematically attractive for long-term positioning. This concept creates a clear shift in mindset. Instead of reacting emotionally to price changes, investors can begin thinking like analysts. The red arrows on the chart no longer represent panic. They represent filtered data that institutions have already studied. In fact, one of the most interesting parts of the bank statement was the explanation that recent price action in digital assets has been challenging, but the macroeconomic environment is gradually preparing for a repricing phase. That single statement reveals a very important roadmap. It tells us that the slowdown in the market is not necessarily the end of the cycle. Instead, it could simply be a restructuring phase before the next major growth wave. Every financial market goes through these phases. Stocks, commodities, real estate, and cryptocurrencies all follow similar cycles. First comes the excitement and rapid growth. Then comes the correction and consolidation phase. And finally, the market stabilizes before beginning the next expansion. Right now, the crypto market may simply be in the consolidation stage of that cycle. For those who understand the pattern, this phase can be incredibly powerful. Instead of chasing volatility, they focus on building positions at levels that offer favorable risk profiles. And according to the data we're analyzing, the $2.80 level may represent one of those critical reference points. But the story becomes even more interesting when we look beyond 2026. Because while the bank lowered its short-term expectations, it simultaneously revealed much higher long-term projections for XRP. And those projections suggest that the real transformation may begin once the asset reaches a very important milestone price level, $7. To understand why $7 matters, you need to stop thinking about XRP only as a cryptocurrency. Instead, you need to start thinking about it as financial infrastructure. Most retail investors trade digital assets like stocks. They buy during hype and sell during fear. But XRP was designed with a different purpose. Its core function is to act as a settlement layer for cross-border payments. In simple terms, it is built to move money between countries faster and cheaper than the traditional banking system. Right now, global cross-border payments are slow and expensive. Banks often rely on outdated systems that can take 1 to 3 days to settle international transfers. These transactions also require multiple intermediaries, which increases costs and delays. Blockchain-based payment systems aim to solve this problem, and this is where XRP becomes important. When the price of an asset reaches a certain level of market capitalization, it gains enough liquidity to handle large institutional transactions. Liquidity simply means that there is enough buying and selling activity to support large transfers without causing massive price swings. The 7 milestone is significant because it pushes XRP closer to a market cap level where it can realistically support mid-tier institutional settlement volumes. This means that at $7, the asset begins to move from being a speculative investment toward becoming a functional financial tool. Think of it as the difference between a startup and a mature company. In the early stages, startups rely on hype and speculation, but once they reach a certain size, their value becomes tied to the real services they provide. The same transition can happen in digital assets. If XRP reaches the $7 level and maintains stability, it signals to financial institutions that the network has enough liquidity to support real-world transactions. At that point, price movements are no longer driven only by traders and social media excitement. Instead, they begin to reflect actual usage of the technology. Let's look at a simple example. Imagine an investor holding 5,000 XRP tokens. If the price reaches $7, that portfolio becomes worth $35,000. For many investors, that amount already represents a meaningful financial cushion. It allows them to make decisions from a position of confidence rather than desperation. But the real importance of the $7 level is not the profit itself. The real importance is what happens after that milestone is reached. At this stage, investors must decide what type of participant they want to be in the market. Some traders will choose to exit early. They might see a strong profit and decide to sell their holdings to lock in gains. There is nothing wrong with this strategy, especially for people who prefer shorter-term trading. However, long-term investors may approach the situation differently. Instead of selling everything, they may adopt a compound strategy. This means selling a small portion of their holdings to recover their initial investment while keeping the remaining tokens for the next phase of growth. This strategy is often referred to as house money. Once your original capital is recovered, the remaining assets are essentially risk-free from a psychological perspective. This makes it much easier to hold through market volatility while waiting for larger long-term targets. And according to the projections we're analyzing, those long-term targets could extend far beyond $7. In fact, the next stages of the roadmap suggest possible price expansions toward double-digit valuations later in the decade. But these projections are not random guesses. They are connected to something that many professional analysts rely on when studying market cycles. It's a mathematical pattern known as the Fibonacci expansion. When banks like Standard Chartered provide long-term projections, they don't just pull numbers out of thin air. They often rely on technical models combined with macroeconomic insights. One of the most widely used tools in financial analysis is the Fibonacci extension, a method that helps identify potential price levels based on past cycles. Here's the simple explanation. Markets often move in waves, and the Fibonacci sequence, yes, the same one you learned in school, provides ratios that describe how these waves expand or contract over time. For XRP, analysts look at previous lows and highs and then apply the 1.618 Fibonacci ratio, also known as the golden ratio, to project possible upside targets. This is exactly why you'll see projections like $12.60 for 2028 and $19.60 for 2029. These numbers are not hype. They align mathematically with the expansion patterns of XRP's prior cycles and the flow of capital into the network. The beauty of this approach is that it gives you a roadmap with measurable reference points. Instead of guessing where the top might be, you have a data-driven range to plan your strategy. Let's break it down for investors. Suppose you enter the market near the 280 baseline. You then accumulate XRP toward the 7 milestone. Once you pass $7, the Fibonacci model suggests a clear path to $12.99 in the years ahead. At these levels, XRP is no longer just a digital token. It begins functioning as a core infrastructure layer for cross-border payments, capable of handling institutional-scale liquidity. At $12.60, your holdings grow significantly. For instance, 1,000 XRP would now be worth $12,600. But the real strategy comes from knowing how much to sell and how much to hold. By liquidating a small portion of your holdings at key Fibonacci levels, you can recover your initial investment while letting the remainder ride higher. This method is often called the seed capital recovery strategy, and it's one of the most powerful tools for long-term investors. It allows you to de-risk your portfolio while still participating in the upside. By the time XRP reaches 1960, the projected target for 2029, the asset may have fully transitioned from speculation to real utility. The network will likely support mid to high-level institutional settlements, meaning that price action will increasingly reflect actual transactional demand, not hype or social media trends. This is where the shift from retail-driven sentiment to institutional dominance becomes evident. Once liquidity depth reaches this level, the market becomes more resilient to flash crashes, and long-term investors can focus on strategy and utility rather than panic. But there's an important caveat. This path is not without risks. Even though Fibonacci projections provide a roadmap, black swan events, regulatory shifts, and macroeconomic changes could temporarily stall the asset's growth. That's why professional traders always layer their strategies, diversify their holdings across multiple exchanges, and prepare exit points to protect their principal. One other point that often gets overlooked is psychological preparation. Many investors get caught up in the hype around a $19, $20 target and make impulsive decisions. But by combining Fibonacci analysis with a disciplined accumulation and exit strategy, you can maintain control over your emotions and focus on calculated decision-making. In essence, this roadmap shows that XRP is not just a gamble on future speculation, it's a structured expansion of value backed by both institutional forecasts and technical market geometry. By aligning your strategy with these levels, you effectively position yourself to participate in the next global infrastructure upgrade, a transition from purely speculative assets to real-world financial utility. The first concept to understand is the accumulation ladder. Instead of buying all your XRP at one price and hoping the market moves in your favor, you spread your purchases across multiple levels. This approach allows you to average down your cost basis and reduce risk while positioning yourself for long-term growth. Here's a simple example. Start building your position near the $2.80 stability zone. This is your low-risk entry point where the bank's analysis suggests downside is limited. Add additional layers as XRP approaches $5, $6, ensuring you're steadily increasing your exposure without overcommitting at any single point. Place final accumulation orders up to $7, the milestone where XRP begins transitioning into a functional settlement layer. By spreading your purchases like this, you avoid the emotional stress of trying to time the bottom, which is almost impossible in any market. Instead, you follow a structured plan that mirrors the actions of professional institutional buyers. Next, let's talk about de-risking your portfolio. Once your XRP reaches a level like $7 or $12, it's smart to liquidate a portion to recover your initial capital. This is called the seed capital recovery strategy. By doing this, the money you initially invested is now out of harm's way, and the remaining holdings become your house money. From this point onward, the upside is essentially risk-free in terms of psychology because your principal is already protected. This method allows you to participate in larger gains without the constant worry of losing your original investment. It's one of the key distinctions between a professional trader and a retail gambler. Another critical piece of protection is diversifying your exchange holdings. Never rely on a single platform to manage a life-changing exit. Technical glitches, regional restrictions, or unexpected platform downtime can freeze your access to assets at the worst possible moment. Using multiple exchanges ensures that you can always execute your strategy when key price levels are reached. For example, many professionals use exchanges like Kraken because of their reliability and robust infrastructure. But even beyond a primary exchange, it's important to split your holdings across multiple reputable platforms to prevent operational risk. This is part of what we call exchange redundancy, and it's essential when building a long-term legacy position in XRP. Now let's link this back to institutional behavior. Banks and hedge funds are constantly analyzing liquidity depth, transaction volume, and market flow. They use this data to determine how much to buy and when. By building your accumulation ladder and protecting your seed capital, you are essentially mirroring the logic of these large institutions, giving yourself the same risk-adjusted advantage. Finally, a note on psychology. Many retail investors panic when the market fluctuates 10 to 20%. With a laddered strategy, daily volatility becomes less intimidating because your position is distributed and your initial investment is already safeguarded. You're no longer reacting to headlines. You're executing a calculated plan. The $28 target for XRP and how it represents more than just a price. It's a North Star for long-term investors. This isn't hype or speculation. It's a roadmap based on institutional math, liquidity analysis, and the real-world adoption of XRP as a settlement layer. By 2030, XRP isn't just a token for traders. It's expected to become a foundational layer of the new global financial system, facilitating high-value cross-border transactions for banks and corporations worldwide. The 2080 target corresponds to the level where XRP can handle massive institutional transfers without slippage, meaning the price reflects actual utility, not social media hype or speculative sentiment. For investors, this target is also a psychological anchor. Imagine holding 5,000 XRP. At $28, that position would be worth $140,000, transforming what started as a standard investment into a life-changing legacy asset. But reaching this point requires discipline, strategic planning, and risk management, not impulsive trading. Here's how to approach it. Follow the accumulation ladder we discussed earlier. Start around $2.80, layer purchases towards $7, and continue building a position toward higher levels like $12.60 and $19.60. Each step mirrors institutional accumulation patterns. Recover your seed capital at key Fibonacci milestones. For example, liquidating part of your holdings at $7 or $12 allows you to secure your initial investment. The remaining assets then become essentially free for long-term growth. Use multiple exchanges to secure your holdings. Don't rely on a single platform for access to your assets at critical price points. Exchange redundancy protects your ability to act when XRP hits its higher targets. Prepare psychologically. Markets fluctuate, headlines mislead, and emotions can destroy gains. By having a clear roadmap and knowing your milestones, you shift from being reactive to proactive. You start operating in the market with purpose, just like large financial institutions do. Another key insight is that XRP's growth isn't linear. The period between $19.60 and $28 represents a velocity phase, where institutional adoption accelerates and liquidity reaches critical mass. During this phase, price movements may be fast and dramatic. If your strategy is sound, this is where house money and long-term positioning pay off. Selling impulsively in this phase can cost you significant gains. The $28 North Star also aligns with XRP capturing a meaningful share of the $150 trillion global cross-border payments market. At this price, XRP becomes a necessary part of the infrastructure. Banks will use it not because they hope for a pump, but because it solves a real-world problem. This is why institutions maintain these projections even if short-term targets are lowered. Finally, let's talk about your role as an investor. The roadmap is clear. Accumulate strategically, protect your principal, and align with institutional behavior. But execution matters. The difference between a hopeful investor and a technical architect is in taking action. You need to layer buys according to your ladder, recover seed capital at Fibonacci milestones, distribute holdings across reliable exchanges, ignore short-term noise, and focus on long-term utility. If executed properly, this strategy doesn't just create wealth. It creates a legacy position, one that can withstand volatility, adapt to regulatory changes, and benefit from the transition to a fully institutionalized financial network. To wrap up, here's the takeaway. $2.80, Xi's stability zone, ideal for accumulation. $7, functional milestone, signaling utility adoption. 1960 trawers, institutional liquidity scaling, and Fibonacci alignment $28 North Star, reflecting full network adoption and global financial infrastructure utility. By following this roadmap, you shift from reacting to market headlines to participating in the future of global finance. That's the core mission of We Are Cosmic, not just tracking crypto prices, but understanding the mechanics behind them and turning knowledge into action.